much, Guru, and welcome everyone to this morning's panel discussion on hedge funds. I am Jennifer Henry, Deputy Chief Investment Officer at STANLIB Multi-Manager and Innate Invest, which is our DFM brand. And it really is a privilege this morning to be speaking and hearing the insights from our industry specialists, not just specialists in hedge funds, but many, many years in experience in investments. And today's topic is around extracting non-correlated and differentiated returns, particularly around hedge funds. And this morning, Jacques, thank you very much. I think you set the scene for some of the concepts that we're going to dig into a lot deeper today. Before getting into those concepts and looking at the practical implications of shorting, I think it would be good to just have a bit of a recap in terms of what shorting is, what this means for gross and net exposures in hedge funds and its assets under management. And thereafter, we will discuss how hedge funds have behaved in different market environments. And then we're going to dig into each of the funds today in terms of those gross and net exposures and use it as a backdrop to understand how our fund managers move around in terms of the different sectors or stocks or shorts and move their net exposures in the funds. So to start us off, I'm going to ask if Clarissa can please take us through shorting and what it means for gross and net exposures, and also why should investors pay attention to those metrics?
Okay, so it has been explained this morning, but if you short a stock, you basically buy a stock that you borrow a stock that you don't actually own and you sell it. Why would you do this? Well, obviously you're hoping that the price of the share will fall. So for example, if I think that Anglo's is massively overvalued, I can go out into the market, I can borrow the stock, I sell Anglo's, it falls a lot, hopefully, and then I buy it back in the market and I give the stock back to the original person that I borrowed it from, and I pocket the difference. So it's a way to profit from shares going down. What it also does is it gives us access to additional capital. So in a normal long-only fund, you have 100% of your capital to work with, but in hedge funds, we actually get access to more than 100% of the capital. If you are long 100% of shares and short 50% of shares in your fund, you actually have positions adding up to 150%, which is your gross exposure. So you have gross exposure more than 100%. And your net exposure in that instance would be your long exposure of 100% minus your short exposure of 50%, giving you net exposure of 50%.
Thanks very much for that explanation. And I'm sure everyone could follow that. Thank you for putting it in simple terms for us. And I think what is important to understand is that hedge funds can have different strategies. Even within a long-short hedge fund, which is what Clarissa has described, you can have funds that have a strategy where they're targeting only 30% net exposures, those targeting even higher net exposures. And you can even have those that actually look for 100%, meaning higher beta and things to the market. And in your presentation this morning, Jacques, you actually showed that you've got different hedge funds within the space. If you could maybe take the audience through these different types of hedge funds, the difference with sort of market neutral, and also sort of interesting, you showed an example around fixed income hedge funds and how that could also, a fixed income trade, and how that could fit into a hedge fund as well. Thanks.
Okay, thanks, Jennifer. So the key difference for us is the net and the gross exposure of the various mandates. So I'm going to start with our high growth fund. And an easy example might be to say our typical position would be about 100% of the fund's capital invested, and then maybe between 30 and 40% of shorts against that. So that leaves you with 100 less 30 to 40, which is 60 to 70% net long, and your gross exposure would be 100 plus the 40, so that's 140. That's kind of where the numbers come from. And then in our market neutral fund, we only limited to 20% of net equities. So in that fund, we might typically be 70% long, and maybe we'll have 40% short against that, or 50% short, leaving you 120% gross with 20% net exposure. What I'll maybe do is, the useful thing would be to go through an example of a share and how we put it in the different mandates and how a hedge fund can implement trades. So last year, 2021 and 2022, our highest conviction position and also biggest alpha generator in the funds was Thungela Coal. We felt the share was massively undervalued. So as a hedge fund, you then sit there and say, how can I put a bigger position in my highest conviction idea while at the same time managing the downside risk for clients? So we've certainly bought some Thungela just outright. You bought outright for the funds, but then once you get to a 5 or 6% outright position, you say, how can I buy more while hedging the risk of the coal price? So two things we did. Firstly, we said Exxaro is another South African coal producer. It's linked to the same sector. The market kind of puts the same kind of volatility and performance on the two. Yet Exxaro has a lot of fixed price and cost plus coal. They're also not paying out all their earnings as a dividend. So that's a nice way to play the Thungela being undervalued, but you hedge out the coal. So we buy an additional 3% of Thungela, and we perhaps hedge that with a 2 or 3% short Thungela or in Exxaro. What we then also do is we say, you can actually trade coal, the commodity. So we can trade futures in the European coal, where Thungela is actually selling their coal, their highest price coal. So we then added another 2% long Thungela, and you short the actual coal contracts in Europe. And basically you say that if coal stays at this level, Thungela is going to be 2 or 3x. It's going to give you 2 or 3 times 100 to 200% return. If coal comes down, Thungela maybe stays flat, but then you make 50 or 70% on your coal. And what we do in our market neutral fund then is you run maybe a slightly smaller position in Thungela, but you ramp up the shorts. So you take out more of the market risk and you run lower net long, but you run a larger gross exposure and you hedge your position more actively. So you take out more downside risk, but try to retain as much of the alpha opportunity as you can.
Okay. Thanks very much, Jacques. And I think that when we're looking at the South African hedge fund market, I think the long short seems to be where there's more funds, and then followed by a market neutral type of strategy. And then we've also seen multi-strategy funds. And I think also during your presentation, you showed us that on average how hedge funds have performed. And I think, just as you will see on the next slide over there, it would be good to also just dig into the uncorrelated performance that you're getting by putting in all of these trades. And just speaking more recently with all the uncertainty and volatility that has come through, particularly between 2022, it would be nice to just dig a bit deeper in terms of how the different hedge fund strategies, in this case we've got long, short and market neutral showing on the slide, how that performed during distinct market changing moments. Marie, I'll hand over to you.
Okay, so this slide that we have up there is quite complex, so you'll have to pay attention closely. If you go to the left, and we can't point to it, so if you go to the left-hand side, it shows for the hedge fund industry literally over the last 15 years, 3 periods where there were big drawdowns. 2008, which was the financial crisis, the COVID crisis, 2020, and then on the right-hand side is the recent one with the whole inflation crisis in 2022. And what we show over there is how the JSE All Share performed is in the yellow color there. And if you look at the first one there, sort of the 3 months, July, September 2008, which was July, then in September, which was the Lehman's crisis, and then you look the month thereafter, October. So you had a max drawdown in that period of probably markets was about 35%. The average, overall, the average hedge fund in SA at that time, I mean, there were more than a dozen around, had a drawdown of less than 30% drawdown. So they had about a 10% drawdown. So protected pretty well. Then you go and look what happened in the 2020 crisis. The drawdowns in 2 of the months there, sort of 10% and 15% for the market. The average hedge fund probably didn't perform as well, average long-short hedge fund, they did 50% of the drawdown, which is still fairly decent. And then if you look in the inflation crisis, the drawdowns that you had two sort of really big months down, probably about 13%, and the average long-short hedge fund only did 2% down. So it's 20% of the drawdown. So the industry is protected extremely well over the three big drawdowns we've had over the last 15 years. And at the same time, we've seen some returns already, but the industry returns have on average, at least matched the markets over that 15-year return. So you're getting lower standard deviation returns, you're protecting on the downside, and that is after fees. So the people who've been around, returns are pretty good. They protect you. And as I said to one of my mates who came in many, many years ago, what happens is people get out when the drawdowns are the worst. And said hedge funds protect you a little bit from that, because if you do get down, you're probably not, you're probably only going to be 30 to 50% the way down if you're in a long-only fund. And that's worked quite well for him. He's still stayed with us since inception, that person.
I mean, if I can maybe add one thing, Maria, I think a key reason why the hedge funds have been able to do this is just the fact the hedge fund industry is small versus the overall asset management industry in SA. Maybe it's 100 billion. That's probably still only 1.5% of the total SA asset management industry. I think in most developed markets like the US, it's around 10%. And that means that at times like what Maria's got on the slide, when things change quickly and you've got to reposition the portfolio rapidly for a new world, doing that on a smaller asset size is significantly easier than if you're managing a few 100 billion where you just can't move the portfolio fast enough. And that together with a few other things certainly go into creating this track record.
Yeah.
And I think that's an important point around the capacity. So as asset allocators, that's something that we need to think about is either the asset class itself or the sector, the capacity it can take. So there's been a lot of growth and more interest in hedge funds, I'd say, over the past 3 years or so, and more so because of the good relative performance in 2022. How should we be thinking about that capacity, specifically given that a lot of the hedge funds are local only? That we're seeing?
I don't think there's infinite capacity in the sector, and certainly not in our business. I mean, we've, I think, been closed for probably 5-6 years out of the 25 years we've been running, where at that time we felt we hit capacity and we couldn't take more flows. Right now, when we're not having issues because we've got some allocation to offshore markets and a fairly well-diversified portfolio. But I think depending on the level of interest, there will be a time when we, and I'm sure some of the other hedge funds, might hit capacity. And because hedge fund fees are higher, it is a performance-driven industry. You have to keep performing for clients, protecting downside and delivering returns. So our view will be that you have to ensure that you can sustain your historic kind of return levels if you want a sustainable business long run. And that will mean when you're at the right capacity level, our view would be that you stop taking inflows or net inflows at that point in time.
Yeah, maybe to add into that, I mean, we're quite a bit smaller. We started off as a hedge fund business. I mean, we run 4 billion of our assets, sort of less than 10% is hedge. We thought it would grow and we'd just be a hedge fund manager. Anyway, that didn't happen. Here we are 15 years later. But I think the biggest constraint for capacity, obviously, is the ability to short. And I think that it's very easy for us, no problem at all, the top 80 stocks being very conservative. We could probably run 10 billion on assets and still be able to do exactly what we do without having really any impact on the ability to short in SA. I mean, just to put in perspective, I mean, the SA market is, whether it's 80 or 100 billion rand, it's probably $2 billion US is the whole South African hedge fund industry. The global industry for hedge funds is $4 trillion. So something's wrong in SA. It's very small. People don't like it in SA.
I mean, as Murray was saying, I think it's important when you're running a hedge fund like we all do, that you have liquidity in your shorts. Because the last thing you want to be is stuck in a short position that you can't get out of, and where there's severe liquidity constraints. So what we've always done is run the business as kind of an institutional business. We've not gone and invested in very small caps or shorted small illiquid stocks. Liquidity is a big thing for us, especially on a short position, but even on long positions. And the benefit to running a smaller fund like a hedge fund is that you do have the ability to get in and out of positions quite fast. You have the ability to, build a substantial position in a stock that you like quite quickly in the fund, which is quite different from some long-only funds. You have to take a long time to slowly build positions, and similarly on the short side. So we concentrate quite heavily on liquidity and not trying to play in the very small illiquid parts of the market.
No, that's very interesting, especially in terms of how you manage the shorts in this market. And just touching on it from a trading perspective, when you do put in a short position or a pair trade, I think managing that through the market uncertainty and volatility must be quite difficult. And therefore, did you find sort of in 2022 and maybe even looking forward that keeping an eye on those shorts has become even more important in portfolio management?
I think it's specifically watching your shorts is always an important part of running a good hedge fund. Just because of the fact that the risk is asymmetric. If you have a long position, you put 100 Rand in, the most you can lose is 100 Rand. It can go to zero in the worst case scenario. If you short a share for 100 Rand, let's say you're an offshore hedge fund, you short GameStop at $3 or $5, the share 20x, so you can actually on the 100 you can lose substantially more. You can lose 1,000 in a worst case scenario. So you always have to have your risk management hat on, and that's why I very much agree with Mario and Clarissa. On the short side, what's important is liquidity. Can you get out if something changes? And also we very carefully track the short interest. Now the short interest is data you can try to get as to how many people are short a certain stock, how much script is available, and Andre touched on it earlier. SA is a good market to run a hedge fund because the hedge fund sector is small. Typically, you have no issue with kind of short squeezes and short interest being too high, but it's still a really good key part of our risk management process, watching that and making sure that there's no risk. But if you stick with like large liquid shares, it really typically is not a problem. Short interest is tiny, and you can kind of safely run your pair. The key thing actually then to monitor is, are you right on your long outperforming your short? Are you right on the long company delivering better results than short?
Yeah. And I think it's interesting that with the strong risk management side of it is that, when one perceives hedge funds, they see it as being extremely risky given the short exposures, given that your gross exposures is more than the assets that's there with the NAV. So, Murray, maybe you'd like just to touch on why is it that hedge funds are not as risky as they may be perceived?
Okay, perhaps to say, I think understanding hedge funds is pretty important because the typical long-short fund, I'd say, is probably takes, instead of being long only, you take 100 million Rand, assume you've got a 100 million book, you go 100 long, and then you probably go and short 50 out. So your net exposure is 50% to the market. That's probably typical, the long-short fund in SA. And so you've got 50% net exposure, and the balance sits on cash. And as long as your longs are as good as your shorts or do better, you're going to do very well. So that's the average. We run 3 different types of hedge funds. We run a market neutral, which has literally is run about 5% net exposure from day one over 14 years. We have the one I've just mentioned at the moment is our medium risk, quite low risk, sort of 2/3 of the vol of the market. And then we have a more aggressive one, which is slightly more vol than the market, that runs about 75-80% net long. So it's understanding the dynamics on your growth. Where people come unstuck on risk, I guess, is shorting. Too big a short, and as Jacques says, you get it wrong, and you get Tesla was a wonderful stock that a lot of people were short, I think, about 5 years ago. And this thing just kept going up and up. Everyone thought it was a house of cards. And the guys in the US just kept buying it. And a lot of people lost money on being short. So you don't just lose the 100%, you can lose 3, 4, 5 times your money. So very dangerous. So that's why I think most of us our shorts are very small. Generally, it can be sort of half the size or 1/3 of the size of your long book. And you have quite a few shorts. You don't go outright one big short. So that's the risk management is very important. And then if you, I guess, if your gross is, which is called leverage, in a RIF, you can't go more than 2 times gearing. So that's the max you can be. The qualified funds can go up to, some of them run it 3 times. But South Africa, generally the managers are very conservative in what they do. And you can see that over time. So it's only when you've seen the track record over many years, you can see what the people are doing, you can see the risk matrices, etc. New fund starts up, you can never be sure what are in the longs, what are the shorts, what is their risk management process. Until you've seen it over time, it's difficult to really grasp what is going on.
Thanks very much, Murray. And as you were describing that, I put up your slide in terms of the gross and net exposures for the Laurium long-short fund. And just as you explained it, that in South Africa, it is regulated for the RIFs to be sort of at the 200% gross exposures. And as you can see that, you know, over time, there is variation in the net exposures, but there are points in times when that net exposure does dip quite a lot, and that is how you are essentially managing the risk within the portfolio.
Yeah, so that on the chart you can see there, we've averaged since inception almost 15 years, an average net exposure for our medium risk fund of 55%, and the grosses I think have been about 145. That's how we've run. So relatively conservative, and that as it's worked out since inception, you generally get, if you do it on a monthly basis, you get about 2/3 of the upside, 1/3 of the downside is how it's worked, and that has enabled us to beat the market by about 1% since inception net of fees. So fairly conservative, and with drawdowns sort of have averaged about 1/3 of the market. Yeah, so much lower risk with similar, slightly better returns in the medium risk portfolio.
Thanks, Murray. And Clarissa, I know that your strategy is different to Murray's in just how it's framed, and one of the ones that Jacques also described to us. Would you like to take us through how you think of the net and gross exposures?
So just to start, I personally am involved with 3 funds at Fairtree. One is called Assegai. It's a qualified investor hedge fund, so not typically for a retail market, but that fund has a long-term track record, and being a qualified investor hedge fund, it can take up to 300% gross exposure. That fund also has between minus 20% and 120% net exposure. So you can see that it's a slightly different mandate from some of the funds that these guys are talking about. It's not aiming to be kind of market neutral. It's actually tending to be aggressively long the market, but hoping to deliver good alpha over time by using all the tools that are available to a hedge fund manager, like shorting and leverage. So that fund has actually done about 21% compound annual growth since inception. And then we have another 2 funds. One is a segregated fund, so it's not open to the public. But what I've put up on this chart is both the history of the segregated fund and then also the more recent history of a fund that we launched, which is very similar to the segregated fund, but it is open to retail clients. It's called the Fairtree Silver Oak Retail Investor Hedge Fund. And as you can see on the chart, our gross exposure has come down quite substantially. That's because the history of this fund, it was more qualified investor hedge fund, and now it's subject to the retail limits. So we now operate this fund below 200% gross. We are at quite high gross at the moment, but giving ourselves a little bit of space on the gross exposure. Markets are a little bit uncertain at the moment, so we are operating below the maximum gross. And then on the net side, we've brought the exposure down. So on our retail fund, we actually have a capped Swix benchmark, and our aim is to outperform the capped Swix benchmark. You pay fees relative to the capped Swix benchmark. So it's a little bit different from your standard hedge fund, which is aiming to outperform cash over time and deliver very low volatility and a decent return. Our fund is almost aiming to beat an equity fund by using additional tools. And if I look at the history of this fund, the segregated fund over time, it's delivered about 19% compound annual growth since inception, which is about 6 years ago.
Great. Thanks, Clarissa. And I think from the conversation so far, again, we're coming back to, hedge funds, even if they are long, short, or even market neutral, they're all going to have nuances in terms of their strategy. So investors really need to look at what the funds are trying to target and their benchmarks before thinking of, sort of either using it in a portfolio or allocating clients to that. And just touching on that and the uses of hedge funds, the Peregrine fund that we're showing here actually has a lower sort of net exposure. And what we have been picking up is that hedge funds are being considered quite often now for sort of living life type or annuity type products, where the hedge fund is seen as the bucket that you could draw an income from. And Jacques, maybe you can touch on using sort of your fund as an example as to why would something that is perceived as being risky as a hedge fund can actually be used as the sort of liquidity bucket for clients.
Okay, so what I'll maybe just first do is quickly just show you one or two interesting things on the gross and net exposure and then move on to that. So if you look at the graph here, around the middle, let's say in October 2021, you can see there our gross exposure spiked from 120 to about 145 in 1 month. So what happened there was RMI owned Outsurance, Momentum and Discovery, and they announced the unbundling of Momentum and Discovery. What we realized immediately was that Outsurance would be an amazing SA asset, one of the truly great SA companies, fast grower. It's had success in Australia. It's going to Ireland now. So as a hedge fund, we can replicate an Outsurance position before the long-only scan. They can only come by once Discovery and Momentum is out, unless they want Discovery and Momentum exposure, but most long-onlys want specific exposure. So that's exactly what a typical hedge fund trade is. We could go 15% long RMI in our funds and have a 10% short in Momentum and Discovery against that and create a 5% Outsurance position like that before the long onlys can buy it. And I think that worked out spectacularly well. So that was a big reason for that spike up in October, for example, and you'll see it then come back down in 2022, partly because of the actual unbundling happening. And when the unbundling happens, you actually get the Discovery and you get the Momentum out, so they just net off against your shorts. You don't even have to trade them. They just net out and you're left with an Outsurance position. So that's a real great tool in the toolbox of hedge funds. And maybe the one other thing worth pointing out there is our net exposure was quite low in the back end of 2022, but we have recently ramped it up to 75-80% because of the value we're seeing in the SA market, where you can never time the low perfectly, but we're happy to start deploying capital there. If I then take it on to a living annuity, any product where the client draws down from the capital, it's important to try to manage drawdowns and have a stable return profile for clients. The worst case scenario is you want to draw out of something when it's down 30 or 40%, which is typically the worst time to take money out the market. So living annuities or hedge funds are ideally suited for living annuities. There's also not the normal regulation 28 limits. So for example, when my dad retired a few years ago, we put 40%, 20% of each of our two funds in there to add stability over and above the long-only and offshore managers he then chose with the balance. And in times of market volatility, it's then easy to draw out of the more stable funds and not take out of an equity fund or an offshore fund at times when the rand is strong or when markets are weak. And I think it's delivered a much smoother profile. And I think a lot of investors watch, like my dad, they watch their portfolio like on a weekly basis. It's kind of, I think, especially when you're retired, it's a fairly significant number in your life. So having that stability makes it easier to stay invested, as Maria said, in difficult times. And I think it's a real value that hedge funds can add.
Thanks so much, Jacques. We've got a question that's come through that speaks a bit to the returns and where does the uncorrelated returns come from? And one of the questions is, what part of those returns come from the cash carry in the portfolio?
Maybe I can say very little. So the cash depends on what your nets are. So the average fund, if you've got 50% exposure, it means your cash component would be around 50%. And if I look over the last 15 years, Steffi, which is sort of basically a blend of cash, slightly higher, that's been about 6%. So if you ran 3% of your return would come from cash if you ran 50 average for 15 years. And so that's very small component is the cash carry, very little. And I see they were also talking about that explains the hurdle rates of many funds is NAV, which is not correct. A lot of funds are different. We have to beat, to take our performance fees, we have to beat, an investor over 12 months has to get at least cash, Steffi. Otherwise, we can't take a performance fee. So here, at minimum, you will get a cash return. So I think very few are just an NAV. Yeah.
Yeah.
But I mean, one point to add there is, as a hedge fund, if you short a share, Clarissa covered on it, you actually get the cash because you've sold the share. You have to buy back, but you're sitting on the cash. So that's why shorting is typically quite attractive at times when interest rates are high. So all you need is for your short to go up less than what you're getting in the bank. So if you can short a share, even if it stays flat or it goes up 5%, you've net made money. So it is a benefit to funds, especially on the short side, if interest rates are high because of the way you deploy your cash. But I still think it's a minority of the returns. I'd agree with Murray.
Okay, thanks. And just regarding the sort of benchmarks, that's the question that was raised there. I think from the funds that I've looked at, you typically do have Steffi as the sort of hurdle, plus quite a lot of the funds that we've seen do also have high watermarks, which is, I think, an even better sort of performance fee type of methodology coming through.
I think almost all hedge funds have a high water mark.
Okay,
Yeah.
so that's good.
We definitely do. You do, yeah.
Yeah.
It's fairly
So-
standard. Yeah, it's
Yeah.
just what is the hurdle?
Yeah.
Cash hurdle. Most you have to beat a cash hurdle to take performance fees. Yeah.
Ours is capped Swix, but that's unusual, as I explained.
Yeah. Okay. Thank you. We've got about 7 or so minutes remaining, and I think what would be nice to do is just to look at each of the funds, sort of how you positioning now, and maybe we can start with Clarissa there. I know that you are running a higher sort of net exposure for this fund, but if you're looking at the Laurium and the Peregrine fund, just directionally, you seem to be reducing your net exposures, whereas the other two are increasing net exposures. Maybe you could just touch on that?
So we do have, you're right, net exposure has come down a little bit. It's also, we've gone through the last couple of months where the fund has actually done very well and the market recovered off a low base. So we've taken some capital off the table. And then, in terms of the fund positioning, we are quite defensively positioned. We have quite a lot of gold, which has done very well for us over the last couple of months. So we've been reducing that position, but it still remains a position in the fund. Similar to what Jacques was referring to earlier, if one looks at the SA Inc. portion of the market, there is a lot of value to be had. Dividend yields are very high and PEs look like they're very low. But there's also concerns around low growth, lack of electricity. Earnings look like they're going to disappoint for many companies and have to be downgraded over time. So if we're looking at a scenario where many SA Inc. companies can't grow their earnings and their PEs could well remain low, we've seen foreign investors leaving South Africa, we've seen local investors increasingly taking money offshore. So the marginal buyer for SA stocks at this point, or SA Inc. stocks, when the sentiment is very bad and load shedding gets worse every day and the politics is bad, is difficult. On the other hand, these stocks are very cheap. And I agree with Jacques completely. Load shedding is not going to stay as bad as it is forever. So at some point, the market is going to get more positive on SA Inc., and it's going to be too late at that point to buy the stocks. So, pair trades in this environment, we've taken down our net exposure in the retail sector, for example, but we've got, pair trades in that sector where we think the stocks that we own will be the ones to benefit in an environment in a tough market, will be able to grow their earnings, will recover the fastest, whereas, other stocks that we've got on the short side, we're not sure how they're going to navigate this tricky environment. So on the SA Inc. side, you have to be careful, you have to pick stocks that are able to navigate this environment. I remain quite negative on the property sector, for example. Commodities, we've got selective exposure because we are quite positive on the China reopening. It's taking a long time to come through. But, those are some of the exposures that we have in the fund. I'm going to stop talking because we're going to run out of time.
Okay, thanks so much, Clarissa. And I think maybe just going back in terms of the slides. Just if we look at the Peregrine side, you've got a bit of an increase coming through in your net exposure. And as Clarissa reminded us, and I'm sure everyone remembers, that you are more positive on, on our South African situation. And maybe if you could just touch on some of the sectors or stocks that's sort of coming through as in your net exposures.
So look, maybe I'll just use a quote or two from our favorite investors. And firstly, it's Charlie Munger, and probably my single favorite quote from him is to say that investing isn't supposed to be easy, and anyone that thinks it's easy is stupid. So the game is hard. And then secondly, Howard Marks has written a few amazing memos and books on investing, and he talks about first level thinking and second level thinking. So first level thinking is, SA is really tough right now, the power's down, or we've got big load shedding, let's sell SA exposure and take that offshore. Second level thinking says, SA is tough right now, but what's prices telling you? And the valuations are already pricing in an extremely bearish scenario. So second level thinking will say, even if SA is tough right now, maybe that's the chance to buy, because the valuations are saying it's even tougher than what it is in reality. So a few shares we've been buying recently is something like Tsogo Casino Group. It's like trading at 6 times earnings. I think they've got results today or tomorrow. So at 6 times earnings, you've got a 16% earnings yield. So even if the company doesn't grow at all, you're getting 16% in earnings yield, which probably goes to dividends and share buybacks. And we think the business easily grows with inflation over time. That's 5 or 6%. So that gets you to above a 20% return, assuming no rating from a ridiculous level of a 6 times PE. If it re-rates to 8 or 9 times, you just make like 100% on a just normal SA mid-cap. So it just shows you that the SA stocks are just priced for a terrible scenario. The key is finding the stocks that's going to consistently deliver earnings even in this environment. So we've been spending a lot of time making sure that the companies we own are not going to miss earnings in the next 6 or 12 months because of load shedding or the tough economy.
Okay. Thanks very much, Jacques. And then Murray, on your side as well, just a slight exposure there on the increase on the net exposure, and also just noticed that all the sort of gross exposures are sort of coming down. Maybe we could just touch on that from your side.
Yeah, so I think in the environment, we brought down our grosses just from a risk point of view. We put on a lot of protection, so we've got put protection on the S&P, which we think looks very expensive, so we bought a lot of puts. Vols have come down to sort of 17, 18. So it's reasonably cheap to put some put spreads on. We've also got some puts on the SA market as well. And where we're finding, banks over retailers, I think banks looking, it was Jacques to touch on earlier, but if you look at the Ned banks, the ABSAs, 0.9 times books, 9% divvy yields, they should grow their earnings this year. The endowment effect, if we get another 50 bips rate hike now, is very good for something like a First Rand and a Nedbank, far better than the retailer. So in retail, we think there's a lot of pressure still, so we've got quite a few shorts on the retail side. We still have quite decent slugs in Naspers, because we think perpetual buybacks, you're getting still a 40%. So intrinsically, there's a big unlock of value continuing to happen, and Tencent looks at least reasonable value as well. So we like that. And I guess on a couple of the commodity side, we've got some Sasol as well. We have hedged Sasol before, just put the oil price against it, similar to what Jacques said, to take out, you say if oil remains at spot, Sasol's on about a 3.5 times forward multiple to June now and forward. They have had their own little bugger ups now and then, but if oil stays where it is, it looks extremely cheap. So we also got a bit of that on the long side.
Thank you very much. We have come close to the end of the session, and we do have one last question there, which is what would be the argument against investing via a hedge fund? I think it's a very broad question, because one is you'd have to understand each asset class and what sort of other options would be available. And, Jacques and Murray, you've explained that, inherently these things are being known to be risky because of the gross exposures, but within a South African context, and particularly for the RIF, that is quite regulated. I think we touched on the fee side of it, but also explained that, these fees typically have got a hurdle rate which is benchmarked to cash and typically do have high watermarks. So I'm just running through some of the comments that came out to sort of address the question that came through from one of our audience members.
Can I add to
Yes,
that, Jennifer? So I think picking managers in general is hard. So I think you've got an extremely hard job. It might even be harder than our job of picking stocks. So I sit on the investment committee at the Mandela Rhodes Foundation, and we've got a big part of the portfolio offshore, and we try to do a fair amount of hedge fund selections offshore. And so that the main argument would be against it is if you don't know the managers or the track record is not long enough and you pick the wrong manager, then you just end up with poor performance and high fees, and you could have been better off investing in an index fund. And I think the job is hard, and I think you've got to look at, do understand how the team makes their money, is their track record repeatable, and do you have a long enough track record? But I think the argument against it would be it's not always easy to pick the good managers. I think SA has a very good pool of managers, but offshore there's a lot of very average hedge funds as well.
Thank you for that, and I think that's an important point. Irrespective of sort of the asset class or the type of fund, it is evaluating the fund manager that's equally as important in this case. So just from my side, thank you very much for listening to us this morning. And from my side, I mean, I've learned a lot just from the understanding of how you maneuver the gross and net exposures. And thank you very much for sharing the detail around all your different trades and how you expect that to add value. Thank you very much.